Good morning, everyone, and welcome to D.I.V.E, Diversity, Including Various Ethnicities. I am Iris Owens, your host, and on the line with me today is my co-host, Stephanie Henry. Good morning, Stephanie. How are you?
Good morning. Good morning.
And on the line also with us today is our illustrious Lanny Arrington. We love you, Lanny. Lanny, and Lanny is with Prosperity Mortgage. And today we're going to be discussing different types of loans. And so this is Lanny's expertise. So Lanny, welcome, and please introduce yourself and we are ready to jump in.
Good morning, Iris and Stephanie. I'm just glad to be here. My name is Lanny Arrington, and I'm the regional manager with Prosperity Mortgage here in the Georgia market. And it's funny when you say expertise. I think that is a nice way of saying you're old and you've done something for a long time. So I'm the old guy, that's perfectly okay.
But you know what? That just means you have great wisdom, and that's what we need from you.
There you go. That's helpful. When it comes to financing, that is a good thing. So.
Yes, absolutely. So we want to, well, first, and I want to also say, so happy Father's Day. So all who were celebrated on yesterday, happy Father's Day. Also, happy Juneteenth, right? I mean, it's wonderful to celebrate this holiday. Happy Pride Month. Happy African American Music Month, Caribbean American Month. There are just so many things in the month of June to celebrate. So we're going to kick off summer soon, but I just want to say just happy June to everybody, right? So we're going to go ahead and get started. So Lanny, with new buyers, right, the whole process of buying a home can be very scary, right? And so my first question to you, and I always think about this, what comes first, home or lender?
Yeah, that's a great question. Great question, Iris. And I try to look back and I think about things and relate it to my personal experiences. I remember buying my first home, my wife and I, we were engaged at the time. We were looking to buy that first starter home, and I was not in the lending industry at the time. And so there's so many different aspects that are intimidating, that are scary, that are just, just things that we take for granted, that the language we use every day and the words we use every day in our industry with real estate, with lending, are things that are foreign to a lot of people, and you can take that for granted at times. And I always have to go back and I try to draw from that when I'm sitting down with first-time home buyers, to really just start with the basics and start from the very beginning. I think when you're looking at, I would say from that perspective, the lender comes first in the sense that unless they're paying cash for that property, they're going to obtain a loan to be able to buy it. And they need to be able to start and kind of look at some dynamics of what does their personal situation look like and how does that impact their loan? Because, if you go around a room of different people, everybody in that room will have a different set of circumstances, different life experiences, different things in their past has taken them down a different financial corridor. So one solution for one person isn't the same for the next person. And you really have to, that's part of our job that makes it interesting, is you have to sit down and look at each individual's dynamics and what is going on in their life and what's the best way to help facilitate and kind of create that bridge to help them get to that home ownership goal they're trying to get to. So typically we start off with a lending perspective and look at it and let's see where we need to go with them for the loan to be able to accomplish what they're trying to do.
Okay. And so something you just said, and this is not a loan, but I wanted to address. So if someone's buying a home cash, what does that mean, Lanny? Because a lot of times people think if I'm buying a cash, I'm going to show up with this bag or this suitcase full of money, and I'm going to come in and I'm going to say, this is my money and I want to buy this house.
Yeah. It's typically not that way. You would have a shorter turn time. But generally speaking, if you're still doing a cash transaction, then they're still going to write the offer with the seller. So there'll be a contractual agreement, for that. So you're right, Iris. A lot of people think, hey, yeah, I'm just going to show up with a bag of money and boom, we're done.
Yes.
But there's typically still title work that's being done to make sure there is no cloud on title to make sure that the ownership is as it's being presented and there's no issue there for that person buying it. You would, even if you're paying cash, you still want to make sure you don't have any kind of issues around the title of the property. And that can take sometimes, depending on the attorney being used and how long the title company takes, you still may be looking at 7 or 8 days to get that title work back. So it's still something that may take you a week or two before you're ready to close on a transaction, even when you're purchasing it with cash.
Awesome. Awesome. Thank you. Thank you. Stephanie.
So one of the things that when you're buying a home, people get confused on are the types of loans. If you're not using cash, I know there's different types of loans that a person can get. Can you talk to those?
Oh, absolutely. Yeah. Well, let me back up and then I'll come to the loan aspect or loan piece. One of the things that, really where I start with a customer is, and again, I'm looking at this, let's assume, or let's look at this as if it were my children. I've got kids, and if they go out and they're looking to buy their first house and things that I'm going to have conversation with them and advice to give them. And it would be where I would say, first and foremost, I think just kind of a big, broader arching thing is to know your numbers. And when I say know your numbers, what I mean by that is when we sit down and talk with a client, they're very seldom do they actually really know how much do I make each month in income. If you sat down and you went around a room, it'd be hard for a lot of people to say to the penny, this is how much I make. Now they may know roughly what they net, but they may not. We qualify off of gross income. So that would be a good place to start for them to kind of go back and look at, their old pay stubs or W-2s from previous years. And let's see, kind of let them get a mental picture of where their income stands right now. Then another aspect will be their assets. Do they, and again, when you're completely new to the process, they may not understand or know, okay, yeah, maybe you can find a loan program that's 100% financing, but there's still cost associated with it. I remember when I walked in that first time when I was buying that house and I sit down with the loan officer and he's going through that estimate with me. And I'm like, what is all of this? You have no idea, you don't have a point of reference. And it's a lot of new terminology. It's all these different things. I mean, as a young person that's never done this, you don't know what a title exam is. You're seeing attorney fees, but what do these really mean? State of Georgia has different fees. And so you're trying to digest all that and figure it out. But the point is there's still cost associated with it to purchase the house, even if you didn't have a down payment to make. And so do you have money for that, for those costs? Do you have, when they go to write the contract and they have to give earnest money, do they have money available to give earnest money? And so them kind of sitting down and looking at where are their assets at? And then kind of the last leg to that chair is also the credit piece. Do they have credit? Have they established any credit? A lot of times we'll talk to a young couple, it may be somebody that's just, that they're freshly out of college, they've started their first job, they're looking to buy a home. And they've only been in the job for a very short period of time. Well, we can use if they are obtaining a job in the field of study, we can use their college history, get college transcripts and use that to establish a work history. And so you can do some different things around that perspective, even if it's a young person without a work history. There's some things you can do there to help them to still be able to buy the home. So, but that, have they established credit? Have they built some history? Have they, ever had anything where we can show what, from a lending perspective, what they're really looking is going, hey, if this person's got a debt obligation, do we feel pretty comfortable that they're going to pay it back? Do they have a history of showing us that they pay it back when they have a debt? And so that's kind of the basic rudimentary things that a lender's looking for. And that history shows that. Now, obviously, a young person doesn't have that history. So what other things can we do? Sometimes there's alternative forms of credit history that you can document. Have they had a gym membership? Did they have a cell phone? If they, some other things that may not report on their credit report, but things that we can use to establish and show that, hey, they've had debt that they have paid back over time. So those are kind of the basic things that, that I would say as a person, you sit down and you evaluate and go, okay, let me get my ducks in a row around these items. And then we go out and we start talking with that lender and looking for programs. Stephanie, to kind of touch on the loan. Oh, I'm sorry.
I have a question. So
Yeah.
you spoke on I mean, it's amazing because, we had another podcast that we dove in.
Last week. Yeah.
Looked into all of this.
Yeah.
But the
Yes.
credit score, so what if they don't have any credit? So their phone bill's always been in the mom and dad's name. They're fresh out of college. The car their mom and dad gave them, or somebody gave them, or they paid cash for it. What if they have no credit?
If they have zero credit and there's no alternative forms of credit that we can go and establish, then that's where they're going to have to go. They'll have to go and look to establish some of that credit. So, and it may be that, hey, they need to go open a Home Depot, credit card and charge $20, pay it off immediately and let it sit there, have some activity on it. They may have to go and do a few different things to establish some credit there. The hope is that we can sit down and creatively come up with some things that we can find that they may not have even, thought about. There's different, just for example, this has been stuff in the past that, I can think of a scenario, even though this has been years ago, where we were working with an underwriter who was very creative and she was very helpful. And we, even in that instance, the borrower's daughter had taken dance lessons, and we were able to show, hey, that she's paid for these dance lessons over a period of time. Now that can't be the primary source of credit. That was just a supplemental source to show some alternative credit. But just being resourceful, looking at things that borrower has done. Sometimes though, you do run into situations where they just have nothing, and that's when you really start building that profile. And that may be a person who they're going to be on a little bit longer trajectory of finding, the home. It may be where they're renting until they get in a position to do it. But we're here to help them, just as y'all are, through that process to get them to the point where they're all ready to buy. Sometimes you can look at some scenarios where, it may be that, hey, a parent's going to buy this property and then eventually the child later then refinances it into their name. Maybe they end up on the title. Later, they refinance it into their name and the parent off of the loan. So there's other things, that down the road that they may look at doing.
Okay.
Okay.
And then you're gonna talk about the types of loans, i.e. what their options are.
Sure. So you get into, from a loan perspective with first-time home buyers, and we have people that will come and they'll ask that and say, I'm looking for a first-time home buyer loan program. Now, typically what they're referring to or what they're meaning by that is just a program that requires less money out of pocket, right? And that's what these are, so a lot of these loan programs aren't specific to just a first-time home buyer. You could be someone that has had a home previously and still may qualify for it. But generally speaking, it's talking to folks that just aren't, they may not have, they're looking for a lower down payment. Your most common, probably traditional, what would be considered a first-time home buyer type of program is an FHA loan. FHA requires a 3.5% down payment. Really, one of the benefits of FHA is that when you're comparing it to a conventional loan, it's a little bit more lenient from a underwriting standpoint. So you can have some credit issues that FHA is more lenient on than what conventional would be. Things of bankruptcy, waiting periods after bankruptcies, waiting periods after foreclosures, those type of things you're not going to have to wait as long on an FHA loan as you would a conventional before you can buy again. Credit score requirements are typically lower on an FHA than they would be on a conventional. They also allow you to carry more monthly reoccurring debt on a FHA loan than it would a conventional loan. So we refer to that as your debt to income ratio. How much debt can you carry each month, and we still feel comfortable that by FHA guidelines or conventional guidelines that you can still effectively make that mortgage payment. So FHA is a little bit more lenient there, so it allows you to qualify for a little bit more. So there's different aspects around FHA that are phenomenal. The VA is probably one of the best, or I think it's probably the best loan or mortgage. Obviously, you have to be a veteran, you have to have that VA eligibility. But if you have the eligibility, that loan program is 100% loan. The interest rates typically for whatever it is in the market at that time is really, really good. No mortgage insurance. It's a fantastic, fantastic product. Now, ourselves, our company, Prosperity, we, in that situation, we also offer a free appraisal for the veteran. There is no origination fee for a veteran. So there's other things that companies do typically, because again, we want to show those people our appreciation for the service that they've served. So, but that's a wonderful, wonderful program. You find in conventional loans, conventional has a 97% financing option. So it only requires a 3% down payment. There's some income restrictions as in some of these programs you do see. You don't see that with FHA or with VA. The conventional lower down payment options have some income restrictions, but that's a fantastic program. And one we have here in our state, and you have it in other states, similar programs. Ours is Georgia Dream, and that is a program through the state of Georgia that basically the borrower can get a forgivable second mortgage, which can allow them to obtain or really almost 100% financing, or in some instances 100% financing. So fantastic loan program there as well. So there's a lot of different things out there, and what you really have to do as a lender is you take that person's their profile and you evaluate it and you look at it and figure out, okay, which is the option that's going to fit them best. Ideally, if they had several options, then you're able to sit down and kind of go through those and let's figure out, which one's going to give you the best payment, what's going to require maybe the least money out of pocket, whatever your priorities are, you're able to kind of tailor that to what they're looking for and what their needs are.
It's something I found interesting. I'm sorry, Stephanie. Oh, go ahead.
Go ahead.
Ask
No,
your
you go
question.
ahead.
I was going to say one thing I found interesting was that, so let's say a person has been approved, has pre-approval on an FHA loan, but I noticed in this current market that we've been in lately, where lenders were going back in and saying, I can get you approved for a conventional loan. And I thought, okay. So can you explain a little bit about that, how that can happen?
Yeah, that's a little bit of a hot button thing for me because in our market, in really over the last 2 years, I feel like we've done a little bit of a disservice for borrowers who are FHA borrowers or VA using an FHA or VA loan. Sellers, there's kind of been this stigma in the marketplace that almost that a VA loan or that a FHA loan is a more risky from a seller perspective as far as that loan closing, that it could be more risk for the seller. And so sellers, they typically have preferred, obviously they prefer cash offers, but then after cash, then typically conventional offers are what they're looking for. Right. As a lender, and you could talk to lenders across the board, and I think they would agree. All conventional borrowers are not created equal. All FHA and VA borrowers are not created equal. You can have a conventional borrower who is barely qualifying, and any little thing, one way or the other, could cause them to then lose their approval. For example, let's say that maybe they've had a home in the past and they had a claim on their insurance. And then when they go to get the new property and they're getting a quote on their new insurance, their insurance is sky high. And so that once they get the new insurance quote, maybe that then could adversely affect their debt to income ratio and their qualifying. Maybe there's something there with their income that's, they haven't worked as much recently for whatever reason. Now their income is a little fluctuating. And so the underwriter has to be a little more conservative in the income calculations. You have much less room for error or any movement on a conventional borrower a lot of times than you would an FHA. FHA, again, being more lenient, it almost gives you a little bit of more of a security blanket around obtaining or maintaining that approval if some things come up that could cause issue during the loan process. And so, so you can look, and it may just simply be that maybe this was a borrower who just didn't have a lot of money that they wanted to put out of pocket. Right. But they're well qualified and they preferred the FHA loan. It could be a veteran who They have excellent credit, but VA being the outstanding loan it is, they want to go with a VA loan. That VA borrower could be a much stronger borrower than that conventional
Absolutely.
borrower. And that seller, by taking that conventional offer over the VA, they may have actually taken the more risky alternative, right?
Mhm.
And so you have to kind of look at all of those things. But in the world we live in a competitive situation where, you, Iris and Stephanie, y'all working as agents, y'all have lived it every day. You're going in,
Yes.
there's multiple offers on a deal and you're trying to make yours look as nice and as good as it can. And you're giving them the correct advice that, hey, unfortunately, the market we're in, the sellers, this is what they're being told or what they've heard. And so this is what they're considering. So sometimes it is figuring out how do we get that borrower to a conventional loan to make their offer more attractive. And so what that may mean for them is just that, there's more money they have to put out of pocket. So the down payment may be a little bit larger to get them to that qualification, either get them to where they qualify or just to where they meet the whatever the conventional loan requirements that they do qualify under to make sure they meet those. But that would be one scenario. One thing that really we've tried to work, and it's been in this marketplace, advice that we give people is to go ahead and get fully underwritten. Go ahead and make loan application with the lender. And when I say with the lender, ideally, this would be my advice, the same thing as with a real estate agent as it would be for a lender. Find somebody in the market where you're looking to buy, a person local. You want to be able to walk in and sit down with Iris. You want to be able to walk in and sit down with Stephanie face to face, have a conversation, tap into their wisdom, let them help guide you. You want the same thing with your lender. You want to be able to go in and sit down with that lender. If you have a loan issue that comes up during the process of the loan, you want to be able to go sit down with them face to face and have a conversation to figure out alternatives or solutions to any of those challenges. If it's a 1-800 number, are you going to get the same person when you have a problem? Are you going to be able to get into contact with anybody? And so regardless of who the lender is, you would want it to be somebody local in market that you could sit down with, face to face. And then you want to go in and you want to make a loan application with them. Go ahead and do the application, start the loan process. That kind of leads us into something that, I know that y'all know this, but it's critical for those buyers to understand the difference in a pre-qualification, just a loan pre-qualification, a pre-approval, and then a commitment letter. What we really see more often than not, you will have loan pre-qualifications. A pre-qualification is when a borrower, they've called, they've spoken to the loan officer, and they've kind of given them their general information. Here's what I make a month. Here's what, I have in the bank. And like we were talking about earlier, that information may not be that accurate. That borrower may not know that stuff exactly. So they're kind of giving you a ballpark, and then the lender's giving them well, yeah, you sound good. This looks good based off of what you've told me. Here is the pre-qualification. The pre-approval is really going one step beyond that, where you actually have obtained bank statements, you've obtained W-2s, pay stubs, things of that nature. You actually have some documents in hand where you can look and go, okay, this is another level, another threshold we've crossed. Yeah, they look good. I have information to substantiate what they've told me. But really the golden ticket is that loan commitment. A loan commitment is when that loan has actually gone to an underwriter. An underwriter has fully underwritten that loan and approved that loan. And so they're making a loan commitment that, hey, we're going to close this loan. You still have typically some conditions such as an appraisal, so that when that borrower does have a property under contract, you want to make sure that it appraised, and title. Again, the title commitment to make sure that there is no issues on title. So, when we can try to get a borrower to that loan commitment level, that then enables them, and we do that before they've ever found a property, that enables them to go and make an offer without a financing contingency, because they already have an approved loan. And that, as y'all know, that makes their offer so much stronger when they're competing against all these other people. So that's really where we're trying to get every borrower, because it makes everybody's life easier and it makes them more effective when they're making offers on properties.
Awesome. Stephanie, you had a question you were going to ask.
Yes.
Thank you, Lanny. That was very Very
I know, it's
informative.
like,
Thank you. I was like, these, and when I'm looking down, I'm trying to write notes because I'm like, hey, this is stuff we all need and we can share with our clients when we're talking to them. Like, this is amazing. Thank you.
Absolutely.
so one of the things as an agent that I find more so my first time home buyers,
Mhm.
they don't understand there's more cost than the down payment.
Mhm.
There's also the closing costs,
Mhm.
and whose cost is the closing cost?
Yeah.
Who
You know,
is normally responsible for that? And yeah.
it's so that's a great question. So historically, in the past, what you would see is a buyer. Think how confusing this can be because it has changed a lot in the last 2 years. So
Mhm.
what historically has been one way for a buyer, maybe when their parents bought a home and friends bought a home and all the things they heard, all of a sudden the last 2 years it's been upside down and it's changed completely.
Yes.
So we went from in the past where everything was negotiable, right? You went in and you were able to negotiate with Mr. Seller. Maybe you split the cost, and so everything was up for negotiation. Well, really over the last 2 years, it's been such a seller's market with multiple offers, all of these different scenarios, that burden of cost has really fallen to the buyer.
Correct.
So the sellers, they've been reluctant or not agreeable to pay anything because they have so many offers on the property that they know they don't have to. They can accept an offer where they're not having to pay anything. And so, but what we've seen as of late, so really, if you were looking at some numbers or just kind of going back through some numbers one day last week, and if you were looking at the beginning of the year, interest rates were in the threes. You were still locking interest rates in the threes.
Mhm.
Current market where we're at right now, that person very likely is going to be in the high fives, even in some instances, depending on their credit, could be in the low sixes.
Mhm.
So you've seen, if you're looking at a payment on a $300,000 property, and I don't have the exact number in front of me, but let's say that payment was $1,200 in January. Now they're looking at an $1,800 payment. So that's a huge increase,
It is.
for that person. We've seen the market move around a lot. Well, what happens is with those rate increases that we've experienced and we've gone through, people now can't qualify for as much home as they did before. So Mr. Seller that's had the house on the market, what we're going to see, and you've started seeing it a little bit, that property that before when it hit the market, it went immediately under contract. Now it's maybe sitting for 3 or 4 days,
Yes.
and you're going to continue to see that balance come back into the marketplace, which is good for buyers. It's really been unbalanced, and I think it's a healthy thing from a perspective of the balance piece, because now I think you will get back to a point where you can negotiate, and that buyer could ask, "Hey, Mr. Seller, I'd like for you to do this. I'm a well qualified buyer, but I just need some assistance here with you covering part of the cost." So, but historically, I would say it was generally split. We've gone through the last 2 years where it was all on the buyer, but I do feel like in the near future, we're going to be where it's going back to where there's some combination of split on the cost.
Mm-hmm. Lanny, do you think it's just the same way how a seller will look at the type of loan, a conventional versus an FHA versus a VA, and thinking that conventional is, of course, more of a secure, gives them a more sense of secure. Do you think a seller looking at a buyer who requires assistance with selling costs or with closing costs rather, makes it a negative thing or gives the seller that sense of they're not a strong buyer?
I guess that it could, but I, I think that you have to look at a lot of different things in that dynamic. One, I think it's how the story's told. So I think it's communication, and it's in that, whether it's when the agents are talking and they're able to kind of say, "Hey, here's, this scenario." What we try to do is as well call listing agents on behalf of our buyers to be able to let them know, hey, how well qualified this person is. It could be simply that they're a really well qualified buyer. They just are young and just don't have a lot of funds, right?
Yes.
And so they need these things, but it's not an impact to their loan. They're very well qualified. So you go through those dynamics and you have those conversations to help kind of paint the picture. I think that price point plays into it a lot too, because again, if you're looking at, if someone is buying a jumbo property, for example, and it's an $800,000 property, and this person is really strapped for cash. As a seller, I would be concerned, right? You're thinking at that price point, you probably want that person to have some money, because typically
Yes.
a lot of the jumbo loans are going to require reserves. They need to have money in the bank to qualify for the loan. So that's kind of sending off some red flags or signals up front if we're already in a position where they may not have the money. So, but if it's a first-time home buyer price range, that type of thing, then those things are going to be a little bit probably less concerning for me as the seller.
Okay, awesome. Stephanie, did you have a question? Because I kind of asked 2 questions back to back already.
Well, so when you're dealing with buyers, what are the 3 most important steps needed when buying a home?
Yeah. So, from that perspective, it's really, as we were talking before, I think it's knowing your numbers, sitting down and establishing, what that income, the assets, and what your credit, what those profiles look like. I think those are probably really the key things as you're getting ready to go down that path of home ownership and figuring it out, knowing what all of your specific information looks like for you, getting your ducks in a row, so to speak, that you're in a good position to go out and to buy. Now, some people may not know, and in all fairness to them, they don't know what they don't know, and they don't know what they need to get in order. And so that may be where a consultation up front, just having that preliminary, let's just kind of look at your scenario. It's like going into the doctor and getting a checkup, and let's just look at it. Let's figure out, where are we today? And that may mean, hey, there's been borrowers over the years that I've worked with that are that way, that they're not ready to do anything right now, and they may not be expecting to do anything right now. They're figuring out, where I want to be somewhere in 6 months, a year. Let's look at it right now. But sitting down, going through with them, and let's evaluate that credit, that asset, and that income portion. And let's figure that out. One thing I love for a borrower to be able to come in and they tell me, I never was the type, when I was looking to buy a home, where I went in and I would tell a loan officer, hey, what's the max I can qualify for? What is the max I can qualify for? I wanted to already have in my mind, what do I feel comfortable with? That's 2 different numbers, So, and everybody's lifestyle is a little bit different. Are you a homebody? Do you love to go out and shop? Do you like to play golf? Do you have a lot of extracurricular activities you like to do? Okay, well, if you do, we need to make sure you leave some money in the bucket for those things, right? You got to be able to go shop and do all the stuff that you get enjoyment out of. If you buy a house and you're house poor and you can't do anything but sit at home and eat TV dinners, that's no good, right? So it's figuring out, where do I want to be and what do I want to do? And it's hard for a lender to be able to tell that person, we can tell you by the book, here's what you qualify for. But that's not a lifestyle thing. Where do you want to be, and what is going to enable you to do that? And so, so you sit down, you have all these different conversations, but I love when they come in and they go, look, I know I may qualify for a $2,000 a month payment, but I don't want that. I want a $1,200 payment. What's going to give me a $1,200 payment? And then we back into that amount, and you can tell them. And then they may go out and they start looking at homes that gives them that $1,200 payment. And this more often than not happens. They realize, I don't really like that house with that $1,200 payment. I think I'm probably have to go to $1,500 to get what I'm okay with. But there's some balance in the middle that they find. And so, because inevitably, if you tell them the very max, here's the max of what you qualify for, they go out and they see one that's a little bit more expensive than what they qualify for. And that's what they fall in love with, right? And then it's like, it's hard to go backwards after you've been there, right? So, so that's kind of the song and dance we always do as we go through this. And I know y'all have experienced it in working with buyers. And so it becomes emotional. It really does. It becomes emotional action, and you're trying to balance all those things and help them get into the best financial place for themselves, while also satisfying that emotional need that they have for that home they're looking for.
Yes. Because I think what for most of us, right, we all have envisioned what we believe our first home is going to look like, right? And I think I always laugh because I said all of these TV shows, Property Brothers, and oh my God, they do not help, right?
No, they don't.
Because
No.
everyone watch it, and then all of these do it yourself
Yeah.
DIYs give people a false sense of security.
Absolutely,
because,
absolutely.
because people believe I can go out and buy this distressed property, and then I can go out and I'm gonna get my hammer and my family's gonna come over and we're just gonna make this thing fabulous. That is not how that works.
No.
Even the best, those who are in the business run into situations. And also what I like to tell buyers is that depending on your loan, you are not going to be able to buy a distressed property.
That's right.
Right? That's something people also don't understand. With a conventional, you may be able to very well buy that rundown piece of property and make it into a beautiful investment. But if you're with you have an FHA or a VA, those don't qualify.
That's
So
right.
people need to understand that. Or people come and say, I want to buy a what do you call it? A foreclosure,
Mhm.
right? Foreclosures, again, it's not as simple as it seems. And you have to know what you're doing, but you also got to know what you're qualifying for and what your loan allows you to be able to buy. I think that's
It
really
is
important.
that is such a great point, because you're so right. The DIY shows, and I love Fixer Upper. I
Yeah,
love
love it.
all the shows. Joanna
Love
Gaines
it.
is so talented, But we get couples. You'll have folks that come along, and that's their mindset. They're like, hey, we're going to go buy this ran down, distressed property, get it dirt
Yes.
cheap, and then we're going to go, man, we're going to make this thing into show
Yes.
place, right?
Yes.
Challenge, a lot of different things around that. A loan product that allows you to do that. What is something that's going to allow you to do it? Most renovation loans, you have to have more money, to be able to put into that transaction. And most of the borrowers who are looking at that property, looking to do that, they don't have the money for those renovation loans, right?
Right.
It does take more money out of their pocket.
Right.
Sometimes the scenario of the property, it's so distressed that you couldn't close on a loan to start with, right? There's safety
Correct.
and hazards and things of that nature. What people don't realize is usually when they're buying that type of property, that's a cash transaction. You're buying it with cash.
Yes.
And then that person is then going and fixing it up. So that's probably not the ideal property for that first time home buyer, somebody who's kind of just easing into the water, buying their home for the first time, right?
Yes.
That's a
Yes.
big undertaking. And kind of what Stephanie, what you were talking about earlier on cost, and then, as we were talking about, they don't understand, or they're just learning, hey, what's the basic cost associated with the transaction? There's some basic things that you're just learning as a first time home buyer and getting comfortable with. And all of a sudden, if you're biting off now, we're going to go renovate a property and we're going to do all this stuff. Boy, that's a very ambitious.
Very ambitious.
They don't end up where they think they're going to end up, and that becomes a very painful process.
Yes, absolutely, absolutely. So, Lanny, with all that you've said today, my brain was clicking, and I'm saying, because we deem June Financial Literacy Month, which it is. And so next month, we're going to talk about, we're going to go dive deeper into credit. And so we were saying, I was thinking to myself, I was like, oh, we need a class on, or I need a session on the ABCs of just real estate, like terminology, because that's really important.
It really is.
And I can see how that could be very scary, even when I'm sitting down with someone and I'm trying to explain to you what this means, right? It still doesn't click, because unless you know anything about what, the market or the industry, that means nothing to you. All you're concerned about is, how am I going to get this house that I want?
Exactly.
And I think it is a great idea to start, as you said, backing into the numbers. That makes so much more sense than me saying, as your agent, let me send you these homes. It would make more sense, right? That when you go to get apply for your loan, that you really do go in with that mindset. Okay, how much house not that I can buy, but that I can literally really afford
And feel comfortable
and feel comfortable with that. And understanding that your first home, it may not be, that's not the forever home, especially based on your age, right? Most people stay in a home, what, 5 years?
Yeah.
So
Right.
it's definitely not your forever home. You buy the first house, you have no kids. You, by the time, year 3, you could have 2 or 3 kids. And now you're like, we need a new house.
Yeah, yeah. Well, in real estate, and if you look at it as a buyer and you look at it for that perspective as an investment, there really isn't better investments than real estate over time in history. If you look and see,
Yes.
it's such a fantastic investment. And so as a buyer, you look at that as, yeah, this isn't my forever home, but this is my starting point. This is where I'm
Right.
jumping into the market. This is where I'm building wealth. So that
Yes.
I then have that money to put into the next transaction. And you see more generational wealth built off of real estate than you do so many
Yes.
other things. And so it really, you look at that and go, okay, this is the starting block, and I'm going to build this equity, but then I can take that equity and I can put it into the next transaction. And they keep working through that process. And then when you get, 20 years down the road, you look and go, okay, this is where I'm at now. Man, you can be in a phenomenal place and it's gotten you where you wanted to be. So I'm thankful for that first time little home buyer house I bought,
Yes.
right? It was a
Yes,
simple house.
absolutely.
It was a great house. We were in it for it was 3.5, maybe 4 years. And it was wonderful for us, but it was not going to be my forever home.
Right.
But it was great for where we were at that stage of life. And it was a good investment and we did well with it. And we took that money and then put it down on the next transaction. So,
Absolutely.
it was good. And that's always just getting in the game and getting started, right?
Right. Absolutely. Absolutely. So, Lanny, do you have any closing thoughts, any closing information that you would like to share with that first time home buyer or someone who's just looking to invest in real estate?
One of the things that excites me, and this is thinking, real estate and lending, and historically you'll hear, you go to a dinner party, you hear, again, you can hear some people that have a great, wonderful, easy experience. You have other people who have challenges. Now, some of those different experiences can be a result of what's going on in their personal lives or issues, because everybody's different, right? They've all got different
Correct.
circumstances. And we don't always know when that person's telling you, they had a difficult time. You don't always know what did they come to the table with. They had a lot of
Right.
baggage and there were a lot of issues, right?
Right.
And so you don't always know all the aspects, but anytime for any of us that things can be easier, it makes it better for the consumer. It makes it better for the loan officer, for the agent, everybody involved in the transaction. And really, I think as an industry, where we're headed is to try to simplify and make the transactions easier. So one of the things that really excites me is we have, for us, but other lenders would have something similar. We have a product that's called Accelerate. Now, what this is, it really ties in more to where Fannie Mae, Freddie Mac, and a lot of the different agencies are trying to go with things where they're doing one of the things they call day one certainty. And day one certainty is it's tied into automated verifications up front. So what does that mean? So that means Mr. Client, when he or she goes and they do the loan application, in our world, they fill out the online loan application. When that comes over, they will have selected if they want to have the credit report pulled. So let's say the credit report, they selected to have that done, the credit report is pulled. It will also run an employment verification. This is all done it's an automated service, so it'll pull through Work Number. ADP has a resource. There's several different things where it'll pull these automated employment verifications, so we can see the borrower's work history, what their income is. So this kind of sharpens that approval, because whereas the borrower may have not known exactly what was their income, now we see exactly what it is. They can link their asset accounts, where we're able to do automated verifications of assets for funds to close. So you literally can do this whole process, and you've got what is almost a fully committed loan shortly after they do the application. It is literally that easy button where it makes the process so much easier. That client, then we don't need pay stubs, we don't need W-2s, I don't need 50 pages of bank statements and all the different things. It makes it so much more simplified for that client. And really, as an industry, that's where everybody's trying to head towards. There's so much information out there already. Why can we not make it easier for the client and the buying experience better? So, that's where we always encourage people, hey, you go and you do that online application so you can take advantage of these automated resources. I think as it moves forward in the process, you'll continue to see that automated parts of our business get amplified and used more and more and more. And it's just going to make it easier for the client and the experience better through them, because we all want that, right? We all want to, if we can do it all from our phone and we can knock it out and it's easy. And that's where we want to get to as an industry. And I think that's where everything's headed. So it's exciting because those things weren't there just several years ago, and now it's getting more and more that way. So it's just a good time, for clients as they are moving through that process.
Awesome. Thank you so much, Lanny. This has been amazing today. Like, I know I've learned some new stuff today that I thought I knew, but I'm well equipped now.
Yeah.
I'm a whole lot better now.
I'm just glad I could come and join. It was I feel honored to be on the podcast with y'all.
No, Lanny, thank you for joining us today. I mean, seriously, you gave us the ABCs of just that starting this process. What do you need to do? What's important? And like I said, we said this was about different types of loans, and it was, but it's really about what comes first, right? What comes first, the home or the lender? And really, it's the lender. It's knowing your numbers.
Yeah. It's
knowing what you really make in terms of what your credit score, what you really bring home, how much you can actually afford. It's really that's where you start. And so we really thank you for that today. I really appreciate you sharing with us and giving us all this wisdom. And so we definitely will have you back, because there'll be a part 2 to this, because there's more to dive into.
There is. There's so much stuff. We can go as deep as y'all like. And so I'm here to help. So certainly I just appreciate being here and be glad to help or participate anytime in the future.
Well, we're going to have you back next month, because next month, as I said, is about credit, and we're going to be deep diving into credit.
Okay, awesome. That's great. Love it.
So thank you so much. Stephanie, any final words?
No, I love what Lenny has said, and it all just ties in to, like, you're ready to buy a home, but you still need to make preparations. You need to know your numbers. Like he said, there's steps that you need to take before you go out and look for that home, because you cannot unsee it.
That's right.
Absolutely.
Right.
Absolutely. Like I said, I love what you said. It's like backing into your numbers, not backing into this house, into this thing, because you're making a commitment to this thing that you may not be able to commit to. But I love backing into your numbers really gives you a realistic to make a plan and a vision for what you're looking to buy. And I think if that is, you're making an investment, you need to be an educated investor.
That's
so
right.
I love that. So
Couldn't
thank
say
you
it better.
so much. Thank you so much.
Well,
So
thank
you guys enjoy the rest of the day. Enjoy your wonderful week. And thank you all so much. Bye.
Thank you.
Good one.
Bye.